Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and what it could mean for ILLR Group Inc. If you've ever wondered why some stocks shoot up seemingly out of nowhere, or what an astronomical borrowing fee tells us, you're in the right place. We're going to break down exactly what makes ILLR stand out on our hard-to-borrow screener right now. Let's start with the basics on ILLR Group Inc. This company operates in the technology/software application sector, running an artificial intelligence-powered technology platform. They're known for the ILLR app, a video sharing application, and also provide services like streamlined SMS, social messaging, AI-powered customer engagement, and cross-platform marketing across Hong Kong, the United States, and internationally. With a market cap currently sitting at around $43.02 million, ILLR is firmly in microcap territory. Looking at recent price action, ILLR saw a significant move today, up 15.64%. However, the last 5 days show a decrease of 9.96%, while the last 30 days are up 4.72%. Volume-wise, today saw 3,352,300 shares traded, which is actually quite low compared to its 30-day average volume of 11,627,129 shares. This gives us a relative volume of just 0.3x average for the day. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow? And why does the cost to borrow figure matter so much? When you want to short sell a stock, you first have to borrow shares from a broker. The cost to borrow, or CTB, is essentially the annualized interest rate you pay to keep those borrowed shares. A high CTB indicates that there is significant demand to short the stock but limited supply of shares available to lend. These fees can easily exceed 100% annually. In fact, sometimes they can be hundreds or even thousands of percent because it's an annualized rate calculated daily, reflecting intense, immediate demand. It matters because this fee cuts directly into the short seller's potential profits, and if it gets too high, it can even force them to buy back their shares regardless of the stock price. Why the stock is hard to borrow right now. Now let's talk about why ILLR Group Inc. has appeared on our hard-to-borrow screener. The numbers are striking. We're seeing an annualized cost to borrow fee of 745.0%. That's not a typo, 745%. Even more remarkable is the momentum behind this. The CTB has surged by an astounding 641 percentage points over just the last 5 trading days. This kind of rapid increase signals a dramatic tightening in the borrow market for ILLR. Adding to this pressure, there are currently only about 200,000 shares available to borrow. Compare that to ILLR's estimated float of 17.9 million shares, and you can see why this stock is considered extremely hard to borrow right now. Our internal composite squeeze score, which combines factors like CTB level, borrow supply, and momentum, currently rates ILLR at 50.3 out of 100. Squeeze mechanics explain. For those new to this, let's quickly explain a short squeeze. Short sellers bet that a stock's price will go down. They borrow shares, sell them, and hope to buy them back later at a lower price to return to the lender, profiting from the difference. A short squeeze happens when the stock price unexpectedly rises significantly. This causes short sellers to face mounting losses, forcing them to cover their positions by buying back the shares they borrowed. This wave of forced buying creates even more upward pressure on the stock price, creating a domino effect, or squeeze. A shrinking supply of borrowable shares, like the mere 200,000 for ILLR, amplifies this effect because it makes it incredibly difficult and expensive for short sellers to maintain their positions or open new ones, increasing the likelihood they might be forced to cover. However, it's crucial to remember that a high cost to borrow doesn't guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. One critical factor to consider with any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the share price, effectively working against a squeeze thesis. This is because it adds supply to the market. For ILLR, we check for recent dilutive SEC filings like S-1, S-3, or 424B over the last 90 days, and we found no such filings. This is a positive sign, as it suggests the company isn't actively creating new share supply that could counteract any short squeeze momentum. Recent reverse split watch. Another important recent development for ILLR Group Inc. is its reverse stock split. ILLR executed a 1-for-10 reverse split on June 23, which was just 14 days ago. A reverse split reduces the total number of outstanding shares and, in turn, proportionally increases the share price. For example, if you own 10 shares at $1 each, after a 1-for-10 reverse split, you'd own 1 share worth $10. Historically, many microcap stocks tend to see renewed volatility or even a temporary price pop within about a month after a reverse split, as the smaller float and higher per share price can sometimes attract new attention or trading activity. It's important to understand this is a pattern observed in some microcap names, not a guarantee or a rule. Such stocks remain highly speculative. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with ILLR going forward? Keep a close eye on that cost to borrow fee. Any further increases, especially if coupled with a dwindling number of available shares to borrow, could signal increasing pressure on short sellers. We'll also be monitoring volume. Today's volume was quite low at 0.3x the average, but any significant spikes, particularly on upward price momentum, could indicate increased buying interest. And don't forget the reverse split. The next couple of weeks could still be a period of elevated volatility for ILLR, in line with some historical patterns for microcaps after such events. Remember that composite squeeze score of 50.3? It means ILLR is showing some significant characteristics but isn't at the extreme end of the squeeze potential spectrum, suggesting caution is still warranted. ILLR Group Inc. presents an interesting case study with its extremely high cost to borrow, rapidly increasing fees, and low borrowable share count, especially in the wake of a recent reverse stock split and without immediate dilution risk. These conditions highlight the intense short interest and the potential for volatility. However, as always, these situations are highly speculative and carry significant risk. Always approach such opportunities with caution, robust research, and a clear understanding of the risks involved. If you found this breakdown insightful, please hit that like button, subscribe to the channel for more deep dives into hard-to-borrow stocks, and let us know in the comments what other stocks you'd like us to analyze next.